Welcome back, YouTube. Thank you all for tuning in. Today, we're going to be talking about what is a credit cap or a credit ceiling, if they really exist, and how to avoid them if they do, and what you should do when you reach your credit cap. So, what is a credit cap? A credit cap is when you've been extended the maximum amount of credit that a lender will lend to you, and therefore you're no longer able to obtain new credit. So when you reach your credit cap, it means that you're now no longer eligible to apply for new credit. If you apply, you're going to be instantly declined. So is this something that happens? Is this something that's real? Is this true? Yes, it is. You can and will reach a credit cap eventually at some point. Everyone has their own individual credit cap, and it's dependent on many different factors. So you can determine your credit cap based upon how your applications are going once you start applying for credit. Otherwise, there's no real way for you to be able to determine your credit cap, because it's something that is figured out by your financial institution's system. So since you're fighting against a computer and you're going through this computer's underwriting, or even if you're going up against manual underwriting, it's up to that computer or up to that person to determine if you've reached your maximum credit limit. So how is that determined? What are factors that are going to determine if you've hit your credit cap? So one of them is going to be too much available credit. So if you have massive amounts of available credit out there, you have 100,000, 200,000, 40,000, maybe you have 300,000 in available credit on your personal credit. So you look at your personal credit profile and there's just massive amounts of credit there that's available to you, and you're not using it. So you have too much available credit, too much freed up credit. It's not being used. Then that could potentially cause you to hit your credit cap. That's going to cause a bank to say, whoa, hold up. This person has too much credit. They're going to be too much of a risk to us. So the next thing is limited income. So if your income is limited, meaning two different things. A, you're working for someone else and that person is determining your income. You're on salary, and your salary is your salary, and it is what it is, and you're stuck with that salary. That can be a limiting factor. That could cause you, depending on how much available credit you already have, to hit a credit cap. When banks see that you're consistent, they like that. However, if you're not going upwards in salary, you're staying in the same place, then banks don't necessarily like lending to someone who is stagnant and not moving forward. The next thing that could cause you to hit your credit cap is high utilization. If you're overutilizing your credit, or if you're underutilizing your credit, it can always be a factor for banks to say, hold up, something's not right here, because either this person has too much available credit out there, or this person doesn't have enough available credit out there. And that's letting us know that there's something not in balance with their finances right now. Something is going awry. And that is why, because these banks are looking at trends. So when they see a certain trend, they're like, hold up, that doesn't match up. I don't know if we're going to lend to this person. So that definitely leads into our next point, which is risk assessment. So banks run you through a computer that determines a risk assessment. It determines how much of a risk you are to lend to, whether or not this bank should be or should not be lending to you. So with that being said, if that bank feels as though you are a risk to them and they should not be lending to you, then they're not going to lend to you. So based upon your risk assessment, that could be a big factor. You know, if you've got a bunch of new credit out there, if you've got a bunch of available credit out there, if you have high utilization, anything that makes you look like a risk. Say last month you didn't use your card at all, this month you swiped 10,000, that makes you look like a risk. What's going on? Why does this person need all this money? You know, what happened? So those are also factors that can cause your risk assessment to change and therefore cause you to hit that credit cap. Now, the next one is going to be your debt to income ratio. So, your debt to income ratio is going to be a ratio determined by how much money you make and how much debt you have. If your debt to income ratio is high, that can be a extremely easy factor to cause denials, to cause you to hit this credit cap and not be able to get any more credit, because the banks are going to see that you are overutilizing your credit for what you can afford. And finally, the last thing that you have to think about with hitting your credit cap is your credit history. If your credit history is short, if you don't show paying overtime for extended periods of time, if you don't show that you're capable of paying, if you don't show that you have managed accounts properly for any extended period of time, that can be the easy factor to cause you to get a denial. So, with that being said, my name is Nigel. If you guys did not know, I bring you guys finance information daily, both business and personal. Make sure you check out my other channel, Build a Business with Nigel, and stay tuned for more videos on this channel. Please subscribe, like, comment, share this video out with others, and I will see you guys in the next video.